I think it's wrong to try and analyze Bitcoin with a macro perspective outside of the longer run. So the longer run is central bank balance sheets are expanding, and that's an ongoing process that will, over the next decade, we expect that to continue. There is very limited correlation between Bitcoin and any other macro thematic. There's very few factors that you can isolate. The factors in Bitcoin right now is this mining shutdown and restrictions in China, and that is causing selling. What's fascinating is crypto volumes have imploded. So that's telling you that the liquidations are over. I think we're in the final stages of this repositioning from China, and the markets will stabilize in due course. We're already seeing whales accumulating at a very rapid rate now, and it feels that the process of Chinese handover of crypto to the world is close to an end. It always happens on the bloody weekend. I don't know why. The Chinese are obviously too busy to do it during the week, and it's only on the weekend they can hit the sell button, and then we have to deal with that. But it is what it is, and I've talked about this a lot. It's very similar to 2013 in Bitcoin. The peak to trough sell-off was about 65%. It feels that this is going to be something very similar, and then before you know it, the narrative changes. I was swapping emails with Tom DeMark, who very graciously sends me the odd email about stuff, and he was looking for the market to trade lower over this weekend, and he's been telling me this for a while now, and he was looking for a potential low of about 25,000 in Bitcoin. That would be the low. And I'm getting a number of different corroborating evidence that somewhere between here and there, and probably in the next week, maybe even less, is the low. And that's how I think about it too. I think we're very, very close.
There seems to be some support at 32,000, 52-week high, 50%.
Also what is interesting is there is this very obvious head and shoulders pattern, which everybody's freaking out about. But it broke it last week and then went straight back above it, which is interesting because normally a pattern like that breaks and it free falls. Let's see what happens over this weekend. But I think people should be on alert for a reversal soon in all of this. That's how I'm looking at it. I think we're done in time and price, pretty close.
I'm also curious, as this is the Enter the Bunker weekend, tell us what you're thinking about right now.
Yeah, so I think the markets are in a transition phase. And I think we're transitioning from the inflation narrative to a lower growth narrative. And Lakshman from ECRI and myself talked about this at the Festival of Learning. It feels that the market is going to be overestimating growth and inflation for the next 6 months, potentially. And that's pretty common. After a recession, you get this growth spurt as everything comes back online, and then it tends to weaken off. So I see a reasonable amount of economic evidence for that, and I'm going to be digging into that over the weekend to look at that. But I think that over the next 6 months, economic growth is weaker, inflation is weaker. Inflation is the hot narrative in markets right now. We had the inflation data today. People are, oh my God, bond yields went up again. But bond yields have actually been falling for a few months now. And that, I've always said, bonds generally speak the truth. Now, question is how far bond yields can fall. And that's what I'm focused on, because this transition is important. If bond yields break, 10-year bonds break 140, which is the uptrend, then they could go significantly lower. That's, again, almost always happens after a recession. Bond yields actually go lower again. So I'm looking for that. I'm looking at the fiscal cliff that's coming. Many of the fiscal policies start rolling off. I'm looking at the effects of the post-reopening, so there's pent-up demand and that slows down how much has been brought forward. And I know that David Rosenberg spoke about that with Ed this week as well on Real Vision.
Yeah.
So I'm looking at all of those things, and I just get the feeling that this transition will see bond yields fall. That probably would coincide with the dollar. The dollar looks like it wants to break upwards from an inverse head and shoulders. I talked about this last week on the daily briefing. Or you can use the Euro chart, which is a fantastic chart, which is a huge head and shoulders top. And if that breaks kind of the 118 level, okay, we could see a significant move from here. That would be the dollar going up. And I've explained to people the dollar going up tends to slow growth, tends to lower the inflation narrative, tends to bring down commodity prices. That would coincide with the falling of bond yields. So there is a potential setup there. I don't know if it's going to happen or not, but that shift would create a shift for markets as well, because value outperforms growth in these more inflationary times because of the discounted future cash flows of these growth businesses. And if that transitions, then we'll see the exponential age stocks start to perform. And we've had a good week for stocks like Apple, ARC, the semiconductor index, and let's say stuff like Twitter. So a lot of these kind of new economy network effect stocks were doing well as bond yields came off, but we haven't got a full signal yet. The other thing about transitions is it can upset markets. It tends to coalesce risk. So if you get a transition in narrative, you can often see a sell-off around that period as well. So I've kind of got my eyes open on all of this stuff right now. Nothing has immensely changed yet. The only thing for me is I see some of the growth indicators coming off. I see the Chinese growth coming off, and I see bond yields overall edging lower. Generally speaking, well, in fact, always, bond yields fall coming out of a recession. They rise at the end of the recession. The growth narrative becomes too excessive because really economies coming out of recession take time before they get traction. And it usually requires 2 more rate cuts, or in the case of the last recession, 5 years of QE before you can let the stabilizers off. So I know everyone's like, oh, the Fed, inflation, but we don't know we can take the stabilizers off. I don't think we can. So normally you get a growth slowdown pretty quickly afterwards. Often equity markets will have some sort of retest, some correction, as they're like, oh, what's going on here? We're going to a double dip recession, what's going on? Bond yields tend to fall. That's usually the process. Then we usually get more stimulus and the markets go up again. Everything recovers. Bond yields either continue to fall or start their rise that happens over the business cycle. So the business cycle is now the predominant driver of what's going on, and that should eventually transition to further growth. And if that happens and the dollar stabilizes, I think it goes up for a bit in this weak growth period. If the dollar then stabilizes, then people start moving out the risk curve. So that's growth stocks will do well, and then out to emerging markets. And that's generally how things play out coming out of recessions. And people over extrapolate commodities. Yes, some commodities are going to do really well over this full cycle, but not all, I don't think. Things like copper I've talked about before, because that's related to the ESG trade, because electricity needs to be conducted somehow, and copper's the best thing in the world to do it. So you need tons of it, or millions of tons of it to be exact. So the sum of these commodities is going to do really well. If the dollar's not falling, then things like agricultural commodities will get over the supply and demand issues, and that will die off. So I don't think we're going to see massive demands for steel and cement and other big kind of industrial stuff. I think we're going to see a bifurcation, which is a word you and I haven't used in a while, but a bifurcation in commodities. And I don't think the commodity trade is a one single trade. And we'll have rolling issues with commodities until the global economy is fully opened and the supply chain backlog has sorted itself out. So, oil could drive higher for the time being. Nat gas is now, is appreciating on the back of the hot summer in the US that looks like it's going to be a record summer. There's a lot of different stories going on, but I think that eases over time and the inflation narrative will ease. And people are going to be focused on, okay, where can I get growth on my capital from? And I think it's going to come from the exponential age style investing. And I think it's going to come from emerging markets.